Hi, everyone. Thanks for coming out. Just so everybody knows, I'm actually out of town. I'm in Castlegar, small town in British Columbia. We actually have a group of us that would visit a friend who moved up here a number of years ago, and unfortunately, 2 years ago he passed away. So we still continue the tradition of traveling up here, visiting his now widowed girlfriend and a lot of the family members and whatnot. So I'm up in Castlegar. Still wanted to make sure that I present the webinar and go over how and why to invest in real estate. So let's get started here. I'll be talking about a lot of different topics today. I'll be talking about why invest in real estate, the power of leverage, the returns that you can expect by investing in real estate, and then go through some of the stages and steps. So you want to first make sure you get a home equity line of credit, or HELOC for short. Step 2 would be then creating a bit of a game plan for yourself. Step 3 would be showing and discussing some of the things that I look at when I'm doing the analysis on a potential acquisition. Step 4 is making sure that you get a community, continue your learning and education and investing in real estate. And then, of course, number 5, taking action. None of this matters. None of this education, et cetera, matters if you don't take action. So important to make sure you do that. So let's get into it and talk about why invest in real estate. And the interesting thing that I've seen is that 90% of all millionaires did so first by investing in real estate. And of course, in Vancouver, I think that's probably even higher than 90%, to be honest. If you bought a property, many of you are millionaires just because you bought a home. So a lot of people do become millionaires just by owning real estate. It's one of the safest asset classes to invest in, and something that you can touch and feel, and you generally need to live somewhere anyways. And so it's something that that is a very easy investment to make, and something that a lot of people believe in and believe that that will return future value over time. One of the main priorities or reasons to look at this is the power of leverage. And so if I look at leverage, the most important thing to understand here is that when you're purchasing a property, you're typically not buying the entire property value with cash. You're usually purchasing it using, anywhere from 5% down if you're buying owner occupied or a second home, and if you're buying a rental property, then it's 20% down. So you do get leverage. And one of the important things I want to talk about on the first-time buyers and owner-occupied situation here, a lot of people expect or feel that in order to be able to buy with 5% down, you have to be purchasing a property that is your first home, and that is not correct. You can actually purchase a property as long as it's an owner-occupied home or a second home with as little as 5% down, even if you are not a first-time buyer. So just something to keep in mind. If you're buying a rental property, however, the minimum down payment is 20% down. Now, let's talk a little bit about an example here. I want to talk about how this would work. So let's say that you're purchasing a rental property, and it's a $500,000 property, and you're buying this as a rental. If you put 20% down payment, that's $100,000. Now, if the home appreciates by $15,000, your return on investment is actually 15%. So the home value going from 500 to 515,000, so going up by 3%, your return on investment would actually be 15%. And that's because you leverage your money 5 to 1. You put 1/5 of the property value down. Your return on your investment is based off of the investment you put into it, which in this case would be your $100,000 down payment. Your investment is not the $500,000 property that you purchased. It's the amount of money that you actually put into it. And so this is one of the main reasons that investing in real estate can generate really good returns, is because of the leverage aspect. Now, this is where things get really cool. Purchasing a primary residence, let's look at the same example here. So if you bought something for $500,000, your minimum down payment is $25,000, so just 5%. So now if you make a $15,000 return on a $25,000 investment, your return on investment is actually 60%. And so this is where things can get a little bit wonky and a bit crazy, and you'd think, wow, 60% return, that's outrageous. But that's just buying a property with 5% down, and if there's 3% annual appreciation of the property, this is a 60% return of your capital every single year. One of the important things to note too is that for a primary residence, there is no capital gains in Canada, so you're not paying tax on that appreciation that you're earning by owning your own home. And so, generally speaking, step number 1 actually really is owning your own home, That's usually the hub of your real estate investing is utilizing your primary residence. So what are the returns and how do you calculate them? The first one is cash flow. Now, interestingly, I've had to change this spreadsheet. I've noticed that a lot of properties with interest rates being as high as they are, especially in British Columbia and Ontario and other provinces where properties are a bit more expensive. In some cases, in fact, a lot of cases right now, the cash flow return purchasing investment real estate in many cases is actually negative, not positive. Normally, and in the past, my presentations would usually show about a 0 to 4% return from cash flow. So that means that if you bought a rental property and you put 20% down, you could expect that maybe the property would break even or maybe generate a little bit of cash flow. Nowadays, in today's market, I find that actually a lot of properties are cash flow negative with 20% down payment. Sometimes if you buy in certain areas, so smaller towns in general, Edmonton, some of these Calgary, some of those other markets, you may be able to find that with 20% down, you may be able to get a positive return. Now, the appreciation is something we've already talked about. If I assume a 3% annual appreciation, that would mean that you could be getting an annual return of about 15% return on your money. And here's the one that people don't think about a lot, which is the mortgage pay down. Because even if you bought a property and have the tenant just covering your mortgage payments for you, you'd still, even if there's no cash flow, you'd still be having the tenant paying down that mortgage. And the return on having a tenant pay down that mortgage for you with today's interest rates would be generally about 5.5 to 7% return. And so if you bought a $500,000 property, put $100,000 down, got a $400,000 mortgage, you'd probably be seeing that your mortgage is getting paid down by about $5,500 to $7,000 per year. And that principal reduction of $5,500 to $7,000 per year on your $100,000 investment is a 5.5 to 7% return. So if you're to add up these in total, many properties, if you're looking at this based off of these numbers, you can expect a return on investment from owning real estate to be anywhere from 16.5 to 24%, which is pretty good, especially comparing that to the S&P 500 and other investments and whatnot. And so owning real estate can be considered a very good return. Obviously, it's a little less liquid than investing in stocks and whatnot. But this is for the primary reason. If you look at the bulk of it and where you're getting the return, it really is, a little bit from cash flow, a decent chunk from the mortgage pay down, but most of it is coming from the appreciation. And this is the primary reason to look at investing in real estate. It is just hard to get this kind of leverage in most investment classes where banks are willing to give you a lot of the money required to purchase the asset. And that's because that the banks and lenders believe that the value of the asset in the future is more likely to be higher as opposed to lower. So, who's interested in investing in real estate based on that? You guys want to make some money? Well, let's talk about, why people don't invest in real estate. And one of the reasons for that is that it is very difficult. It is challenging. There's lots of moving parts. And one of the issues, of course, is getting a mortgage. It's a lot more difficult than it used to be. Back when I started 17 years ago, it was a lot easier to get a mortgage. We could take an application and throw it at the wall, and a lot of them would stick. In fact, most of them would. Nowadays, it's becoming more challenging, more difficult to qualify for a mortgage, and that's one of the reasons that people are held back from making that first step. But what I'd like to do is I'd like to just break this down into some easy steps and some things that you can do. If you're not really sure where to start, then let's break it down into just a step-by-step type of process. So step one, it's all about accessing capital. Realistically, usually people are doing this by accessing the equity that's in their home. So if you don't already own a home, then step zero is usually just own your own home, get a property. As we showed earlier, that leverage, if you're putting only 5% down, you're getting a 20-to-1 ratio on that leverage. Every 1% of appreciation in the real estate represents 20% return on your investment when you only put 5% down. And so that would definitely be step zero. Many of you that are watching this already own your own home. And the first step in that case usually is to get a home equity line of credit. And so using the same example, if the property is worth about $500,000 and you, let's say, only owe $225,000 on your mortgage, you could restructure this and set this up so you have a line of credit available to you for $175,000. And what ends up happening is as you pay down that mortgage, your line of credit limit slowly increases. And you can then utilize this line of credit to then invest. And you can actually borrow money against your property to invest. Whenever you borrow money to invest, with the intention of earning an income, the interest cost is tax deductible. And this is one of the most important keys with investing, is that as you invest and you start to grow your income and grow your wealth, you need to start to look at, it's not just about making the money; it's also about keeping the money, and making sure that you're positioned in a really good spot from a tax perspective is really important. So I do still have a few. I don't have a lot of these books left, but I do have some books left at my office that speak specifically about making sure that your mortgage is tax deductible. And if you'd like a copy of that book, you can email us at info@greenmortgageteam.ca, and we'll be happy to put a copy in the mail. You just need to send us your mailing address, and we'll send a copy to you. So if you've got access to capital now, so you've figured this out, you've got some home equity in your home, and you've got that available, or if you have cash available, and of course on the plan side of things, there's lots of things to look at and talk about. But it really comes down to making sure that you create a plan and then you stick to it and you start to execute on it. There's a lot of different ways of building your portfolio in real estate, but you do need to have a plan. Now, one of the first things that I often do when I'm sitting down with somebody to figure out a plan for them is we often want to actually close some doors. We want to say these doors are open for you, but these ones are actually closed based on your income. What are the financial realities of your situation? And try to look at, where do you want to be in 5 or 10 years, and where are you today? And then build that bridge and build that plan. Somebody that wants to own 10 properties in the next 2 years, that's a very different game plan than somebody that wants to buy 1 or 2 properties in total over 10 years, and being able to figure out how to execute that plan. Somebody that wants to buy 10 properties in 2 years probably needs to find a lot of money, and that might be raising capital through investors and other people. And somebody that wants to buy 1 or 2, maybe it's much easier for them to do that on their own. Some strategies would include just keeping everything that you buy. If you buy a condo for yourself to live in with 5% down, great. And then when you're ready to upgrade, maybe buy a townhouse and maybe buy that one with 5% down again. And then when you're ready to upgrade again, buy a house with 5% down. And so there are ways that you can create different plans. I do find it's a lot easier to provide a game plan with people when we know where they want to be, but also what are the financial realities of your situation, because that will also determine which doors are open and which doors are closed to you. And so as you start to create that game plan and look at, where do you go? What are the different strategies? Generally speaking, people move in this direction. They usually start off with a residence, then they buy their first rentals, and then they're buying up to 5 rentals, and then they're buying number 5 or plus, and often looking at commercial. And so the strategy and the game plan and the structure of your finances does often change as you build this and grow it. And somebody that wants to buy up to 5 properties is different than somebody that wants to buy over 5 properties or buying commercial. If you just want to own your own residence, then that's a different game plan altogether. Because what we'll find is that with your own residence, a lot of people want to pay that mortgage off faster, and that's a very good thing in general. However, there are certain situations where if you have really high payments on that mortgage on your residence, you might not qualify to buy your first rental. So there's lots of little things to change, and the structure, especially as you grow the portfolio, becomes more focused on access to capital and less focused on the interest rate that you're getting on the mortgage. Not to say that the interest rate is not important, because it really is, but the number of times that we've refinanced and restructured clients' portfolios to access an extra couple $100,000, and maybe the rate's 0.1 or 0.2% higher because we had to use different lender with different guidelines, it does allow people to invest that capital and make a much higher return with that extra capital than the difference in their interest rate. And so the plan really does change, and depending on where you want to take things, it does create a different structure and a different game plan for you. Now, on the qualifying side of things, I do want to touch on this because it is a really important thing to understand how you do qualify for mortgages. And so most lenders use something like this, which is an add to income method. So they take about 50% of the rent, add it to your income, but then they only want about 40% of your income to be used towards all of your debts. And so if you had $1,000 a month in rental income and they take 50%, so 500, and then they only want about 40% of your income to be used towards all of your debts, then only $200 of that rental income is being used towards helping you qualify, which is not a lot. There are some lenders that use what's called an offset, and an offset is a little bit different. What they would do is they take up to about 80% of the rental income, and they use that $800 to offset all the expenses first. And so in theory, if the expenses, including the mortgage, are only $800 a month, then there may be no net effect of owning that rental property in your portfolio. The add to income method, you're always adding an income and an expense. And so no matter what, there's always some, in general, net negative effect on owning that rental property, whereas an offset in general is much better usually when qualifying. And so in that case, they're actually using about $800 of the rental income instead of only $200. And most of it is not due to the percentage used, it's actually due to the method of using an offset instead of an add to income method. There's one other method that is also used, and I'll say that this used to be a lot more common, and just very recently, a lot of lenders have been changing their guidelines on this on the residential side, and so it's becoming more and more common, primarily on just the commercial side and small business side. Whereas we used to have a few lenders on the residential side that would use this, and nowadays most of the lenders are not using it anymore. But they were typically looking at is they want to see that the portfolio and the property that you're financing are covering themselves. And usually that ratio of income to expenses usually is anywhere from 1.1 to 1.2. On the commercial side, it really varies, but anywhere from 1.1 to 1.25, sometimes even higher depending on the type of asset. But so they're using all of the income, but they want to make sure that there is a surplus of income being used in that case. And so these are the three most commonly used methods of calculating rental income. And in general, add to income is much worse than a rental offset. And then the DCR compared to an offset often is very similar. And so after you've got an understanding of, okay, I have access to capital, step one. Step two, I've created a bit of a game plan. Now, the third thing you want to start to do is analyze deals and run an analysis. And so I like to use some shortcuts. And it's not because I'm lazy, it's because you have a big filter and you're looking at properties over and over and over again. And what you want to be able to do is you want to be able to look at a property and very quickly assess whether it's in market or not in market, and whether it's likely to cash flow or not, and whether the numbers are likely to fit. And so one of the things I look at here is what's called a rent to price ratio. So if I look at a $500,000 property, I'm going to want to know that the rental income is at least $2,000 a month. In general, you need even more than that to cash flow positive, but not too long ago when interest rates were a little bit lower, in general, if the monthly rent was 0.4% of the purchase price, then generally speaking, it would be about cash flow neutral with 20% down. So again, in today's market, you probably need more than $2,000 a month in rent on a $500,000 property to cash flow it positively or neutral. But this is a really good general rule of thumb. And even if you'll find that that the ratio is at 0.45 and it may not cash flow, but at least you can do some quick math. This is the easiest way to know if a property is going to be, cash flowing or not, is just to look at what the rent to price ratio is. Another thing that I like to look at too, another shortcut, is just knowing what the cost per 100 grand is. And of course, you can use the cost per 10 grand too. But the cost per 100 grand on a mortgage right now is about $570 per month per 100 grand. So if I'm looking at two properties side by side and one is $100,000 more than the other, then the question to me is, well, how much more rental income will this property generate? If it generates at least $600 more per month, then I think that property will actually cash flow better, because even if I borrow the entire difference in the purchase price, I'll actually still generate more cash flow by buying that property. Another interesting thing to look at too, especially with the provincial government in BC starting to offer more grants to put basement suites into homes. This is something to look at too, even just on a renovation metric, or if you're buying your own primary residence, is looking at getting a property with and without a suite in it. And you'll find in general, most of the time, it is financially in your best interest to have a basement suite in the property based on the additional cost. You'll find that it's often anywhere from $50,000 to $200,000 extra to have a basement suite in a home. And usually you're getting more than that cost per month to borrow all of that money in rental income. And yes, of course, there is a difference in the quality of life. You're not going to have a basement all for your own personal use. And so there's different things that you need to trade off. However, from strictly from a cash flow perspective, in most cases, it usually makes sense to have a basement suite in the primary residence. Another thing that I mentioned is making sure that you utilize tools. So again, looking at that filter, how do you get from looking at a property to knowing if it's a good fit? using tools. And so I do have a cash flow analysis spreadsheet. It's available on our website. You can also email us at info@greenmortgageteam.ca to get a copy. But it's a spreadsheet where you punch in the high level information. So the purchase price, the rental income, the vacancy rate, the expenses. It'll automatically calculate your mortgage payments for you, and it'll calculate what your cash flow is and what your return on investment would be to purchase that property too. So a lot of clients use that. So you might use the rent to price ratio really quickly to see which properties you like, and then when you narrow it down and drill it down, you might say, okay, I've got two different properties I like, and you can use the cash flow analysis to figure out which property seems to have the better overall return on investment between the two of them. Another tool that I use a lot is called Rentometer. So traditionally, people would often go to Craigslist or Kijiji to look up rental income. I really like using Rentometer. It gives you macro data on a marketplace, and so you punch in the address, you punch in the rental amount that you're expecting, and it'll give you 25th, 50th, 75th percentile rental income numbers. So it'll give you a lot of different macro data that you can utilize to help gauge the marketplace and have a good understanding of how much rental income a market may generate. And I think that's something that is really important. A couple of other things to do here is just making sure that you're using specific metrics to compare the return on investment. And so this is where I come back to using the cash flow analysis spreadsheet. And I would also, like, something that I do a lot myself personally is if I'm looking at properties that are in two different markets, I might say, well, this smaller town has better cash flow than this property that's in a major urban center, has less cash flow, but I do expect that it would have more appreciation. And frankly, I think that this is often, not always, but often is the case where, generally speaking, major urban properties tend to have better cash flow over a long period, or better appreciation over long periods of time, whereas smaller towns tend to have better cash flow, but less appreciation over time. I often like to then tweak it, and I might say, okay, the property in the major urban center, I'm going to use a 3% annual appreciation or a 4% annual appreciation for that one. And then I'll compare that to the better cash flow property. And for that one, maybe I'll use a 2% annual appreciation. And then I can compare it and see, well, this one's better cash flow, but less appreciation. And what is that final number? What is the overall return on investment difference between the two properties? The other thing that's important too is to try to quickly gain an understanding of a market. If you have a really good idea of what the rental rates are in a for market, and also when you start to compare and look at deals, you might find that condos work really good in this market, but detached properties with basement suites work better in that market. Then you can start to really drill things down, and maybe you're not looking for condos in the market where you know that the detached properties with basement suites tend to pencil out better. So trying to focus on one or just a couple of key markets will accelerate things, and it'll make it easier for you to complete a deal analysis and do it accurately. This is just a snapshot of what the cash flow analysis spreadsheet looks like. So if you'd like a copy, just email us and we'll be happy to send it over to you. So step 4 is just getting connected. I would say that one of the things that's important here in investing in real estate is there's so many different people out there that can give you advice and feedback on how to invest in real estate, where to do it. There's lots of different investment groups, and if you're looking for different contacts and different people, if you're looking for lawyers, accountants, even just customers or clients that have invested in different areas or markets, feel free to reach out to me. I'm happy to connect you or give you some feedback on where to get started. And of course, none of this matters if you don't take any action. You're just sitting there watching your tail, thinking about it. The inability to take action. I've had a lot of customers that have been waiting on the sidelines for 5 years, 10 years, just waiting for the market to fall out, and it doesn't happen. And next thing you know, they're still wanting to get into the market, but it gets more and more and more expensive. The other thing too is that writing an offer with subjects and with due diligence requirements, it is something where you get to learn a little bit. Even if you don't end up actually going through with the deal, you get to learn a lot by just writing an offer with subjects, and then that way you can do your due diligence. And as long as you have good subjects in your contract, talk to your realtor obviously about how to write that up in the best possible way to protect you. But if you're writing an offer and you decide not to go through with it, then you probably at least have learned a lot on going through the process. So it's important to take all of this knowledge and actually turn it into action, and do something with this knowledge. Otherwise, you're spending your time learning about it, but not actually doing anything. I do have a couple of quick tips that I want to talk about. And so, one of the things that comes up quite often is people say, well, I have a lot of equity in my home. Can't I qualify for a mortgage? And reality is that lenders are focusing on debt servicing. So it's all about what is your income and what are your expenses. And one of the things they look at is not the amount of money you're borrowing, but what are the payments on that money that you're borrowing, or that amount. And so some of the things that come up, of course, is taking a longer amortization on all of your debt. I know that it seems counterintuitive, especially in your primary residence, which is generally not tax deductible unless you've borrowed money to invest out of it. It seems counterintuitive to stretch that amortization back out to 30 years, but I say this is probably one of the most common things that we do when we first restructure somebody. We say, okay, we're going to get you a home equity line of credit, and we're going to stretch the amortization up to 30 years. And keep in mind that most banks allow you to pay off 15 to 20% per year on the original principal balance, which is a lot. It allows you to pay off the mortgage really aggressively if you actually take advantage of it. Even if you're on that long amortization, you can still pay it off at the same rate if you want to. But the minimum monthly payment on a 30-year amortization, the lowest you can go, is now going to help you qualify for more debt in the future. Especially when we went back a few slides earlier about how lenders treat rental income. In general, every rental property that you buy is a net negative on your application, not a net positive. And so the more that you can ensure that you're taking a longer amortization on all of your debt, that's going to help you. Another thing that really helps you is eliminating all of your other high interest debt. So if you have credit cards, lines of credit, those are usually something that we roll up into the mortgage at that time. Another example would be a car loan. So if you owed only 25 grand on a car loan with a payment of about $550 a month, well, that payment on that car is about the same as borrowing 100 grand on a mortgage. Because we went over that a few slides earlier, that currently per 100 grand is about $570 a month. Well, if you have a car with a payment of 550 a month, and that's eating up 100 grand of your borrowing power. And you might only owe $25,000 on the car, but yet is reducing the mortgage borrowing power by 100,000. So that's something that's really important to think about. And getting a HELOC should be step number one. When you get a home equity line of credit and you get that large line of credit amount, banks are assuming that you're going to borrow all of that money and pay interest on all of that money. And so they want to make sure that you can qualify to do so. If you buy a bunch of rentals and then you realize, oh, I need access to more capital, and then try to go re-qualifying later, then you're going to find that all of those rental properties, because remember, they're generally a net negative on your application, will make it harder for you to go get a larger line of credit. So generally speaking, getting the HELOC should be step number one. It also is an opportunity to then restructure your debt, re-amortize it, load up and put in any of the other debts that you have into the mortgage to reduce your overall monthly liabilities. And it's important to follow your game plan. A phrase that I really like is that if you fail to plan, you plan to fail. It's important that you figure out a game plan, you stick to it. If you say you're going to be, reviewing properties every month, then do it. Make sure that you follow the game plan. I do have people that sometimes will veer in different directions, and they say, "Oh, what about this and what about that?" And that shiny penny syndrome can be very distracting. And last but not least, surrounding yourself with experts who understand how to invest in real estate. There's lots of good lawyers, lots of good accountants out there, but not all of them will focus on specifically on how to invest in real estate. And of course, tooting my own horn here, a lot of mortgage brokers or bankers do not focus on investing in real estate. They focus on different types of mortgages. 95 or so percent of mortgages are for people that are buying their own home, not for investors. And so there are some different structures and strategies that are important to think about, especially as you get into that echelon. If you are buying multiple properties, then it makes it a lot harder. And there are things that you may not know are going to be issues later on in growing your portfolio that somebody with a lot of experience is going to know about. Some examples of this would be buying in a personal name or company name. This can be very difficult and challenging, knowing where you're at today, and sometimes the decision is made based on where you're at today and not where you want to be in 5 or 10 years. And so things like that are really important to make sure that you're talking with really good experts. So a question I've been getting a lot lately is, okay, Kyle, great. This is nice to know how to invest in real estate, but is now the time to buy? And it's tricky. I mean, observing the marketplace right now, it seems like the market has picked up. Everybody that I talk to is saying that they're getting busier overall. I am noticing that that on a personal level and in my brokerage, in general, all of our agents are closing more business. There is more activity going on in the marketplace, and it's an interesting time right now. I know I've seen a few reports from big banks like RBC, et cetera, as well as CMHC, suggesting that that values by the end of next year are likely to be higher. And I've seen that that stat. It's usually in the single digits as far as the appreciation is concerned, but I think I saw one that was as high as 8 or 9% higher by the end of next year, which was a bit surprising to me, to be honest. I didn't expect that the number would be that high. But it does seem like the predictions are showing, well, values are likely to be higher in the near future. So the interesting thing is, okay, well, why would values go up? It's mostly because of the curve or expectations. And so, I'm showing you two different charts here. One of them, the orange, is the current prime rate, and the forecast of where the prime rate is likely to be heading. And so the current outlook is that the prime rate would be down about 0.75% by the end of by about 12 months from now, and then another 0.5% lower in 2 years, and then continuing to drop a little bit into year three. Now, the bottom one here, blue, is not the actual interest rates. This is what's called a 4-year swap. It's basically a proxy of what's likely to happen with fixed rate mortgages in Canada. Generally speaking, you're going to look at the 4-rate swap and then add a premium to that. The reason that I'm showing this chart is just that it's giving you an indication of which direction and by how much the rates are expected to go down. And it is interesting to see here that the chart for fixed rates anyways does go down, and then it actually ticks up a little bit in the next couple of years. And so if we observe this, then it's looking like interest rates for the fixed rate side of things would be dropping about 0.5% to maybe 0.75% over the next couple of years, whereas the prime rate is looking like almost a 2% drop over the next couple of years. And so if we do see interest rates drop like that, it creates this interesting position where, you have, if you're buying an investment property, you'd have negative cash flow now, but also on the flip side, you're expecting, well, yeah, but I think the values will be higher in the future. So, do I buy a property knowing that the cash flow is negative, but also knowing that if I don't buy now, then maybe the values are higher in the future? And so when you compare that, you look at, okay, well, if I was to wait and buy a property later when interest rates drop, even if rates drop by 1%, which, by the way, is more than what was expected based on that chart that I showed you, 1% on a $500,000 mortgage would be about $5,000 of savings. But if you were if you had a home worth $500,000, a typical 3% annual appreciation is $15,000. And so if the market appreciates at a kind of a standard expected appreciation rate, the appreciation would be more than the savings on the mortgage. So this is where the long answer is, do I think now is a great time to buy? Not really. But at the same time, too, I think that if you want to buy real estate, if you want to get in, I think it's better now than it will be in a year or 2 years from now, because I do think, based on the data that we're seeing, what I'm feeling right now, and what others are reporting, is that values are likely to be higher in the future. Another reason to consider this too is that rental rates are way up. So I'm looking at first, this is based in March 2023. And so this was a year over year, March 2022 to March 2023. You can look at this chart. The rental rates and increases year over year and month over month for most of these markets was way up. And so looking at 15 to 22% increases in many different markets across Canada. It was pretty major increases. Now in 2024, so now we're comparing April 2023 to April 2024, not quite as drastic, but you're still seeing in most of these areas that the year over year increases are still there. So we're only seeing on this chart, Vancouver actually dropped by 1.1%, which is kind of interesting, but yet North Van increased by 6.1%. So I'm not sure what's going on there. Oakville also is one of the spots that dropped a little bit. Everywhere else is static or still continue to increase, which is very, very interesting. And so that's something to think about and consider, is that not only is the cash flow perhaps a little worse today, but if there's continued upward pressure on rental rates because of the inflation, then that means that you're likely to see higher rents in the future. And yes, of course, most of these markets like Vancouver or Ontario and BC there are rental restrictions. You can't just charge whatever rental rate you want. You do have to follow procedures if you have the same tenant. But it does mean that if interest rates are to drop and value or rent amounts are slowly going to increase, then your cash flow should improve in the next couple of years too. So I know I've gone over a lot of information today, but if you do want to learn more, feel free to book a consultation with myself or one of my members of my team today. We also have I've written a book called Rockstar Real Estate Investing, and I am giving that book away. Anybody that doesn't already have a copy, feel free to reach out. You can email us at info@greenmortgageteam.ca. I'd be happy to put a copy of my book in the mail. And if you do want to contact us, we're located in Vancouver at 2608 Granville Street. There's all of our contact information. And thanks for watching the presentation. What I'll do now is I will answer some questions that you guys have put in the chat. Feel free to use the Q&A as well. If you guys have any questions, feel free to pop that in there. Let's see here. So Jerry has a question. What are your thoughts on purchasing a pre-sale condo with a 2+ year build period? With rates expected to come down, demand to increase, theoretically value should rise. However, the economy, inflation, and government, Bank of Canada, rates may stay much higher longer than expected. Yeah, it's an interesting one. I'm not always a fan of pre-sales because you're making a buying decision today and then closing on the property in the future. That being said, I actually feel like pre-sales are actually a good investment as of now. You're putting in 10, 15, 20% of your cash on deposit, and you're not closing on the property for a couple of years. And the benefits then is that you're not taking the mortgage today, so you're not in a cash flow negative position, but you still get to get the effect of any appreciation that occurs between writing the contract today and when you close on it. And secondly, especially in areas like BC and Ontario where there are restrictions on rental rates, if you're buying a property and there is continued upward pressure on rental rates, then what ends up happening is you get to put a tenant in there in a couple of years at market rates in 2 years, as opposed to buying a property today and putting a tenant in today and then never really being able to catch up if there is continued upward pressure on rent rates. And so I'm interested in pre-sales. I'm not usually a huge fan of pre-sales myself, but I am a little bit more interested in pre-sales today in this current economy. And I do think that values are more likely to go up than go down. I do think that rates are more likely to go down than up. Although I will preface this and say that perhaps rates won't come down as much as some people have been expecting or hoping. The charts and information is showing us that we're not going to see major decreases as much as we initially thought down to interest rates. It seems like the inflation is a bit stickier than expected. One other point I'll make is just a few months ago, it seemed like we were expecting much deeper discounts on interest rates. And then all of a sudden the pendulum kind of swung a little bit. And one of the reasons for that is that the US is showing a lot of strength. So Canada is showing a lot of weakness and some cracks in its foundation, but the US is not. And the reason that's relevant for us up here in Canada is that, one, our financial markets are very intertwined. But number two, the issue is that if we start to drop our prime rate and decrease interest rates, it has a negative effect on our dollar as well. So it actually would push our dollar down relative to the US dollar. So if we go down more than the US does, then our dollar will deflate a little bit. And the problem is that then it makes it more expensive whenever we're importing goods from the US or from any other country that did not decrease the rates as much as we did. And so the interesting thing is that it actually is creating more inflation if interest rates go down more in Canada than they do in other areas. And so we almost to a certain point rely a little bit on the US to also be dropping rates. And if they don't, it seems like Canada might not be able to drop the rates as much as we would otherwise like to. Andrew has a question. What are the challenges with rental or investment properties is the change in the capital gains tax? What is the strategy in the lower mainland properties to deal with this? Well, there really isn't much of a strategy to deal with it, unfortunately. The capital gains tax is changing. It's changing in late June, and so there will be more capital gains tax that will be applicable to properties starting at that point in time. So it is a factor, and unfortunately, there's not an easy way to get around it. At least not that I'm aware of or know of with accountants or lawyers at this point in time. Just important to note and keep in mind. a primary residence is exempt from the capital gains. And so one of the ways to perhaps look at a strategy is to buy properties where you could improve the property a fair bit, something that you're going to keep and live in yourself for a few years. And maybe your game plan is to hop around every few years and make sure that it's long enough, but hop around every couple of years, buy property that could use a little bit of work, improve the value of it, live in it, and then eventually sell it, and then buy a new residence, and then do that all over again. You and your family may not like to live in a renovation zone all the time, which is a different situation altogether. But if you're looking at a way to completely get away or around the capital gains tax, then that's one potential strategy. I will preface this all by saying you need to talk to an accountant. I'm not an accountant, and you need to make sure that if you're looking at trying to figure out a tax strategy, you need to talk to an individual to get an idea of what the best strategy is for you from a tax perspective. I'm just going to put my email in the chat because I think that that has been requested. So I'm just going to do that now. Team.ca. Yes, if you need to reach out, you can send this out to me directly, Kyle@greenmortgageteam.ca. Another question, income for qualifying for a per 100 grand. So in general, you need about $25,000 of income per 100 grand that you're borrowing, assuming you have no other debts. Now, when you scale that up quite a bit and you're looking at more expensive homes with higher incomes, it's not quite 25 grand per 100 grand borrow that you require. You can get away with maybe $22,000 or $23,000 of income, but that would be somebody that, let's say, a household income of $300,000 wanting to borrow 1.5 million. The numbers may be a little bit different for people in that situation, but in general, for an individual buying their own home, especially in a 25-year amortization, then you're looking at about 25 grand of income required per 100 grand borrowed. Any other questions? You guys are taking it easy on me here today. Well, if you guys have no other questions, then maybe we'll wrap it up. Feel free to reach out to us. I offered a couple of things today, some spreadsheets, a couple of books. Feel free to reach out, send us an email, and if you have any questions, happy to help you. And thanks so much for attending. Looking forward to speaking with all of you soon. Thanks a lot. Oh, one other question here, Andrew. Is there any advantage to getting real estate to your kids? Yes, because if that is your kid's primary residence, Andrew, and then that could be a way of avoiding the capital gains too. So if you're trying to figure out a wealth strategy and you own some rentals and your kids are getting to that age now where they need their own place, then you could gift the properties to the kids. And if they're living in it, then there's no capital gains for them. So then it avoids the capital gains issue that you were mentioning earlier. So yeah. All right, everyone. Well, I'll wrap up. And thanks so much for attending. Looking forward to talking to all of you soon. Thanks a lot. Bye now.